All right, good afternoon, everyone. We're going to wait just a moment here, and when the clock strikes 12, we're going to get going. Christopher Cahill, 12 Points Wealth Management, thank you for joining us for our presentation on risk management in the age of COVID-19. We will be starting here again in just a moment. All right, by my clock, we've now crested the noon hour. I want to be efficient with your time and respectful of your time, so thank you for joining me here today, and hopefully this will be of some interest and value to you as you proceed through what is, and by all outward appearances, a really strange time. So let me proceed forward here. This is who I am, Christopher Cahill. I am an attorney, a certified financial planner, and a chartered advisor in philanthropy. I'm a partner and principal with the firm of 12 Points Wealth Management. I have particular expertise in working with lawyers and law firms, business owners, CEOs, C-suite execs, and wealthy families, and specialize in really doing estate planning and all manner of wealth management. Financial planning, retirement planning, philanthropic planning, and risk management. So today we're actually going to talk about risk management. So as we all know, life has changed, right? It's just different today than it's ever been. Nobody would have expected this. Nobody did expect it, but here we are, right? I'm fortunate enough to be working out of the office a couple of days a week now after having had a nice long hiatus at home. But it's allowed me to really reflect on the things that are important, as I'm sure it has with all of you. So as this slide says, you know, life has changed for all of us, but this is an excellent time to take stock of the financial situation that you're in and make sure that obvious risks are addressed. Sometimes the obvious risks are the ones that we fail to really pay attention to and fail to see and capture. So some of this stuff might be a little basic today, some of it might be new and thought-provoking. So we're going to just get into it. My objective is always to do these presentations in under a half an hour if I can, allow you to get on with your day, have your lunch, and do all the things that you need to do. So we're talking about risks. A big risk for many of our clients and many of you out there in the webinar land is really just having an inappropriate or non-appropriate emergency fund. So we all know we need one. COVID-19 has really reinforced that. If we don't have an appropriate emergency fund, what's that going to do? It's going to put us at risk, right? If we get furloughed, if we get laid off, if we get sick, how are we going to make our financial commitments? How are we going to provide for our families, our children, et cetera, ourselves? So general financial planning principles dictate that you have approximately 6 months of living expenses on hand at any time. That's great. That's, you know, traditional stuff that everybody says. Some people have a difficult time getting there, admittedly. So how do you do it? You got to really start with a budget. What do you need? What are your true living expense numbers? Once you've been able to identify what those expenses are, you can really solve for saving for them, right? So you got to have a solid budget. You got to prioritize savings towards that emergency fund as a key. Those of you that are young and just starting out in your financial careers, I would say that that's the most important thing, is getting a substantial emergency fund on hand, even at the risk of potentially foregoing some other things that you might feel are appropriate and important, even so much as the funding of retirement accounts. I know that a lot of people want to come right out of the gate and start funding for retirement, but trust me when I tell you, you need to have some cash on hand. I think this has been a pretty clear indication of this COVID situation. So those of you that own homes and might have an inadequate emergency fund, utilizing a home equity line of credit can oftentimes smooth out those troubling and difficult times financially. So, you know, you don't want to put yourself in debt unnecessarily, but having access to those funds can be a lifeline. So I would recommend looking at a home equity line of credit. And now with housing prices having increased as much as they have, it's probably a good time to do so. So another risk, stress and mental health. Let's face it, this stinks. Working from home, being unsure as to what's going on in the world, worrying about your family, your friends, yourself, your own health. Is your job going to last? Are you going to be able to make the objectives that you've set forth for yourself financially, et cetera? So, just take the time, pay attention to what's going on in your life and the lives of the ones that you care about and love. Pay attention to if you're particularly stressed, if you're not sleeping well at night, if you're particularly sharp and short with your family or coworkers. Maybe these are signs that you should talk to somebody candidly. So I'm not a psychiatrist. I don't know what more I'm talking about aside from the fact that I know it's important to pay attention to stress, how it impacts you, your family, and just get help. If you're depressed, if you've got anxiety issues, please do yourself and the ones that love you and care for you a favor and get some assistance. As I said, I'm going to continue through pretty quickly today. You want to be prepared for potential job loss, no matter how secure you feel in your job. Businesses are under tremendous stress right now. Many are going to continue to struggle, and there's a risk of being furloughed and laid off for virtually all of us, unless you own the business. And even still, there's no certainty that the business will continue even if you own it, just given where we're at right now, right? Not to be doom and gloom, but there's been, many millions of people laid off since this COVID-19 pandemic hit. Through no fault of your own, you could be out of work. This is why that emergency fund that we just discussed before is so critical, right? You need to have cash reserves. You need to be able to pay some bills if you're in between jobs. You need to make sure that you've got an updated resume. You need to make sure that you've been networking, that you've been, farming that garden of contacts that you've got to potentially call upon in the event that you need it. Nobody expects to be laid off, but if you are, you need to have a plan B, and hopefully thinking about what would happen if will be something that will be of benefit. Again, not to put you back on the former slide where it's stress and mental health issues, but do just kind of think about it and get yourself prepared for that what-if scenario. Those of you that know me know that I can't do a presentation without talking about estate planning. It's a personal focus of mine. It's something that I'm particularly interested in helping my clients achieve and be organized in. So, the ultimate question is, do you have legal documents in place? Most folks really, at a young age, don't. Even those that are middle-aged and approaching retirement oftentimes will have really old documents. So what do you need, right? You need to have a will. That'll dictate where the assets go when you pass. Most people will utilize a trust in conjunction with the will. That will be the ultimate dispositive document that distributes the assets to the beneficiaries. You need healthcare proxies. What a healthcare proxy will do is allow somebody to make medical decisions for you in the event that you become incapacitated. Given where we're at right now, that's more likely than it ever was. So having somebody that can make decisions for you and talk to your doctors is really important. It's got to have a HIPAA authorization. What's that going to do? That's going to allow your healthcare proxy to get access to your personally protected healthcare information, your medical records. If you don't have that, they're not likely going to be able to make informed decisions. The durable power of attorney, that will permit the power holder, your attorney in fact, to be able to make financial decisions for you, pay bills, renegotiate rent and or leases or mortgages, etc., handle business contracts. All of the stuff that you could do for yourself if you were able to, but assuming that you become disabled or incapacitated, you're going to need somebody to handle that. The big risk here that I kind of glossed over at the beginning of this slide, and I shouldn't have, is the fact that if you don't have legal documents in place, you're really defaulting to what we call being intestate. And in being intestate means that the state is going to make decisions about where your assets go. It's also going to make decisions about who will be identified as the personal representative on your estate or the executor, depending upon where you live. And most importantly, they're going to decide who's the guardian of your children. If you have minor children, this is a huge issue. Why would you allow somebody else to make these decisions for you? You need to have documents. They don't need to be exotic, they don't need to be expensive, but they need to exist, and they need to identify the things that you care about. Who will take care of your kids, where are your assets going to go? If you have more wealth, you certainly want to be focused on tax minimization strategies, etc. But for purposes of basic estate planning, this is what we need: wills, trusts, health cares, etc. Another important note, those of you like myself that have children that are now over the age of 18 and no longer considered minors, you need to have legal documents for them. They don't need grandiose things. They really need a healthcare proxy, a HIPAA authorization, and a durable power of attorney. It should say that on this slide as well. So once they hit the age of majority, you can no longer make medical decisions for them. The doctors will no longer talk to you. If your child becomes sick while they're attending college or anywhere else for that matter, the old days of you just picking up the phone and talking to the physician are gone. They are legally not permitted to and will not talk to you, absent you showing them a document that says that the child has appointed you as their healthcare agent or their personally identified HIPAA authorization. These things are really, really important. I just had my son execute his yesterday on his 19th birthday, and he's going to college tomorrow, believe it or not. So here we are. For those of you that have documents, take them out, look at them, brush them off, blow the dust off of them. When's the last time you reviewed these documents? You know, the risk is that you have documents that are outdated, either because of tax reasons or they no longer reflect your current planning objectives. They could identify people as personal representative or guardian of your children or whomever. They could have trustees that are either people that you no longer want to have in those roles or are no longer capable. Maybe they're incapacitated. Maybe they've passed away. Whatever that case may be, you really want to look at these things. I would say at a bare minimum every 3 to 5 years to just make sure, absent some big family life change, you know, a marriage, a death, the birth of a child, these sorts of things, you really need to just take them out, look at them, and make sure that they still make sense to you. So what we see here is, when do you do a refresh? As we said, you know, if you feel that they're not reflecting your current objectives, do they name the appropriate people? How often? We've talked about that. And, you know, you really want to pay attention to tax law changes, and we're going to talk about tax law changes here in just a minute. So there's some stuff coming down the pike potentially that might make estate planning reviews really, really important coming forward. Okay. Here's a really interesting thought. Some of you married very wealthy individuals or individuals that came from wealthy families. They might have access to trusts and inheritances that is wonderful for them. That's probably very helpful to you as a family as it relates to paying bills and acquiring and investing and doing things, acquiring assets and investing and doing things that are beneficial to the family unit. More often than not, unfortunately, if that spouse predeceases you, those assets are not going to come to you. So what could happen is you'd have an unequal access to the inheritance. Point of fact, you might not have any access to it. So if that happens, what you could see is the assets being distributed downstream to potentially your children, hopefully. If you don't have children, the assets might revert back to the family or to other members that are not you. So what might happen is that you might not have access to the assets and the standard of living that you thought you would. So you really want to pay attention to this. And for those individuals that have that situation, you know, a really simple solution is obvious here, right? Just have a life insurance policy on the spouse that has the assets and the trust and the inheritance, and just have that backfill through. In the event that they pass away, you lose access to those assets. Those assets are made up in the form of a life insurance death benefit. All right. those of you that have family members with special needs, and this is not specific to children, it could be siblings, it could be parents, it could be aunts, uncles, people that you care about. You need to pay attention to this. You need to make sure that you have documents and a plan in place. So you're going to certainly need a qualified special needs attorney to draft documents. You're going to need to figure out how much money you need to provide for this beneficiary. Is it a serious need that's going to require around-the-clock care that's going to potentially go on for 60 plus years? If so, that's a big number. Run the math, extrapolate it, add growth to it, break out the Hewlett-Packard and see what the numbers are. We can help you think this through. If you can't do it on your own, we'd love to talk to you about it. But you got to then figure out how you're going to fund it. Those needs. You can start saving for it. If you have wealth, you can carve it out in your estate planning documents if you have wealth already. If you don't have wealth already, and even if you do, life insurance, again, can be a really great solution for providing a certainty of result. So many of our clients that have beneficiaries, whether they be children or grandchildren, that have some sort of special needs, do the best that they can to identify what those needs are going to cost into the future, and then they come back to us and acquire a life insurance policy that's going to provide for that amount of benefit. Put it into a trust, have a good, solid special needs trust with the beneficiary being the individual with the special needs, not having access to it. They can't demand principal or income. It'll be a discretionary trust as it relates to their benefit. And then you'll have a trustee that's going to be able to help think through what is an appropriate distribution scheme to and for that beneficiary. So really, really important to pay attention to that sort of stuff. All right, if you own property, particularly rental property, this is a risk that is lurking behind the scenes for many of you. We see people just go buy property and own it themselves. That's a huge recipe for disaster. You want to check the titling, make sure that you don't own these properties in your name and your spouse's name. You really want to own them as a separate entity, typically in the form of a limited liability company or in the form of a trust, just some way to get it outside of your personal assets. The reason that we say that, even though there's costs associated with creating and maintaining an LLC or a trust, you really want to do that to segregate the asset and the potential liability that comes with it from you and your personal balance sheet. You don't want to have somebody slip and fall on a property, have a significant injury, and then be coming after you personally and have all of the hard work and all that you've done as it relates to earning an income and saving be squandered via a lawsuit. That's not what we want for you. So pay attention to that. If you fall into this category, simply reach out. We can help you think it through. So as I said, there's potential tax law changes coming, right? We don't know what's going to happen. We are in an election year. Yay, go 2020. But depending upon what happens, we might very well have some significant tax changes in 2021. You know, income taxes are likely to go up pretty dramatically if we have a change of administration. Now, you can spin this any number of different ways, but you know, it's something that you want to pay attention to. You might want to start planning now. State taxes are always a point of concern for us. You can manage your state taxation by managing your domicile. In the age of COVID, a lot of people have decided that they're going to move. They're going to live in a different place. They found they no longer need to live and work right next to their office. Maybe they can work remotely full time. If that's you, you might want to think about living in a jurisdiction that has zero income tax. A place like, say, New Hampshire, Texas, Florida, etc., South Dakota, these sorts of states that have zero state income tax are particularly attractive. Of course, you have to want to live there otherwise, but you know, putting things on the page, all things being equal, that's important to pay attention to. So, tax law changes potentially coming. Let's look at what some of those things might be. Capital gains taxes have been approximately 20% when you add up state and federal tax for quite some time, for the most of us, depending upon where you live. But they could increase pretty dramatically under some proposals that we're seeing out there. If that were to come to pass, I mean, they could go up, they could almost double. I'm hearing 39.6% potentially. If that's the case, those of you with built-in gains, whether it's in property, real property, business assets, or simple stock accounts, taxable accounts. If you own Apple and you've been riding it up through the roof over the last several years like it's been going, you know, now might not be a bad time to contemplate taking some of those gains off of the table, potentially at a 20% rate, rather than a double that in the future. I'm not saying I would do all of it, but it's certainly something to think about. You might want to consider some sort of capital gains management program and start thinking about booking some of those gains now. Certainly any losses that you have obviously can offset those gains, but those losses might be more potentially attractive in 2021, to be honest, right? So these are things that you want to pay attention to. The federal estate tax exemption is right now 11.5 million, give or take. It's indexed for inflation. It's a huge number, excuse me. That amount means that a family can pass over $22 million federally estate tax free to their beneficiaries right now, a married couple, I should say. That's a huge amount of money, right? 2026, that law is set to sunset under current laws. So even without a change of administration, without an extension of that law and a revisit through Congress, that law is going to revert, the exemption will revert back to where it was prior to the passage, which will mean about 5.5 million indexed for inflation per spouse. So in essence, it'll get cut in half. That's a big difference potentially for some of you out there. For a lot of my clients, I know for a fact that this is going to be an issue. So what we need to do is pay attention to this, right? Even under that sunset rule, as I said, in 2026, we could have a reversion back to a much more aggressive estate tax at the federal level. And of course, if we have a change of administration, there's certain reasons to believe that the estate tax exemption will come back down pretty dramatically. So if you, again, as it says here, if you have significant assets, you might want to start considering about what to do with some of those things now. You know, the old standbys of gifting assets out of your estate to trust, uber smart, critical. These are things that we do all the time for our clients. You know, if you have an asset that's hyper appreciating that's in your estate, whether it's a business asset or some other asset that's got built-in gains that you want to avoid recognizing right now, you could freeze that through a sale to a trust, maybe to an intentionally defective trust, intentionally defective grantor trust, excuse me. We could use spousal lifetime access trusts, things like this, where you'd be able to move assets for the benefit of your spouse and your family, but theoretically have a little bit of access to it through your spouse if needed. Certainly life insurance is a wonderful mechanism for paying an estate tax liability in the future. Certainly an area that I think is going to be a big issue going forward. In fact, could it be the golden age of life insurance? It might be. Life insurance policies currently do provide significant tax advantages. Death benefits tax-free, estate tax-free, death benefit paid is capital gains tax-free, it's income tax-free. The cash value in a permanent policy currently grows tax-deferred. So all of those things are really beneficial to you as the end user and to your beneficiaries. And I really feel that this is going to be something that's going to be heightened over the next several years for sure, especially if there's a change of administration. Withdrawals from the cash value up to basis can come out tax-free. That's a big mechanism for retirement funding for many of you, and should be and probably will be going forward. And then after you get the basis out, you can take loans, and those can also be tax-free. So in essence, the cash value in your life insurance policies can really be a good funding vehicle for retirement purposes. We do anticipate an increased interest in permanent life insurance with cash values going forward to take advantage of these benefits. And we expect that this is going to be something that, should there be a change of administration, will become really, really important really quickly. These are the tax advantages of life insurance. We just went over them: death benefits, tax-free, cash values, grow tax deferred, get tax-free withdrawals. You certainly want to keep current with your policy, make sure that that you're paying attention to its structure, so on and so forth. Why would you buy life insurance? Old reasons are the same still: income replacement for a spouse in the event that you pass, or a family member; debt repayment, whether it's college loans, student loans, mortgages, business debt, etc. You might want to fund some specific event. Grandparents often buy a policy to say, I'm going to use this to fund college education in the event that I'm not around for my grandchildren. Certainly burial expenses or asset diversification. There's a whole host of reasons there. Those of you that have life insurance currently, you certainly want to do a policy review rather regularly. It is important to pay attention to these to make sure that the policies are performing as illustrated, especially those policies that are either interest rate sensitive, meaning whole life policies, or universal life policies. Interest rates have dropped through the floor, as we know, and that has impacted how those policies are going to perform. And then similarly, those policies that are based upon investment returns, whether they're variable universal life policies that have sub-accounts with mutual funds, etc., those are subject to volatility, right? Both positive and sometime, maybe, if we ever see the market retrench again, negative. But for now, this is something that I can't stress enough. If you have life insurance, particularly permanent insurance, you want to pay attention to it. Even term insurance. Some of those policies have conversion features that you'll really want to make sure you think about long and hard before they pass, especially if there's been a change in health. I had a client recently that had a term policy. They've been diagnosed with a medical condition that makes it impossible for them to get new life insurance, but we were able to identify that they had an existing term policy that we could convert, turn into a permanent policy for them to ensure that the family would get that death benefit. Is it going to cost more? Certainly it is, but it's going to provide a benefit for certain to the family as well. So that's something to certainly pay attention to through an annual audit. If you have a life insurance policy that by no fault of your own, or even if it is, you missed a premium, whatever, that's failing. If you have a policy that's failing, you really want to make sure that you pay attention to it. You can restructure it. You can put more money into it. You can replace it. Or you could surrender it, take the cash value, go away, and you no longer need it. Or there's a marketplace out there for selling a policy. It's called senior settlements. Oftentimes an intriguing and potentially interesting and lucrative solution for somebody that no longer needs a policy. If you had a policy particularly that was issued at a preferred rate, and for some reason you've had a medical condition that's made it less likely that you're going to lead a normal life expectancy, and for whatever reason you no longer need that policy, that policy could have value to somebody else. Disability insurance. I'm going to get real quick through here because we're coming down to our allotted time. Disability insurance is critical. We really want to make sure that your income is protected, especially in this day and age here. We're selling a lot of disability insurance. There's a renewed interest in it for many of our clients. The statistics are scary. You're 3 times more likely to be disabled than to die prematurely. That means before the age of 65. You have a 1 in 3 chance that you'll be disabled for at least 90 days by the time you're 65. The average term of a disability is 30 months, many of them being longer. And if you fail to provide for a disability, what's going to happen? Potentially bankruptcy. Really devastating to you, to the family, These are things that we want to make sure that you avoid. You can have a disability policy, a group policy through your firm that you work at. Similarly, you can acquire one on your own to supplement and/or control. I typically recommend that. I think it's beneficial as an individual to own your own disability insurance, kind of control your destiny. I do call it income replacement insurance when I'm speaking with my clients, because that's really what we have. Want to pay attention to the definitions of these policies, make sure that you're going to be able to, if you're a physician or a skilled professional in some capacity, the last thing you want to do is be forced back to work at Starbucks, McDonald's, or whatever. So the definition of incapacity in your work is really critical. You want to make sure that you're covering 60% of your income, and that the skills, the occupational coverage is really what I was just describing, is appropriate for you and your family and your situation. So, high earners, those of you that work at, say, law firms where I do a lot of work, I'll give you a hypothetical here. Most firms I run into have a disability policy, a group DI policy that'll pay $10,000 a month. What that does is covers approximately $200,000 of comp if you consider it to be $10,000 of tax-free income to you. If that's the case, if you make $500,000 like many of the lawyers that I work with do, you've got $300,000 of uncovered compensation in the event that you're disabled. That would really hamper you, your family, from attaining and achieving all of those financial goals that you've set for yourself. Make it difficult to pay for college for your kids, for instance. It'd be difficult to have you set aside appropriate money for retirement, and any number of other things. So just be thoughtful about it. People don't really like talking about insurance, but I think today, in today's world, it really is important to focus on and pay attention to. You got to review it just like you do your life insurance. No surprise there. We can help you with that. Longevity risk. You don't want to run out of your money. How do you protect against that? Certainly, annuities are going to become really important to protect against running out of your cash. So how do you do this as well? You really need to have some forecasting tools, some cash flow management tools, and modeling capacity to figure out, do you have enough, and what is enough for you and your family? We do a lot of financial planning and modeling for our clients. If you have questions as to how much you need, we're happy to speak to you about that. We're happy to run models for you. We really use these as guideposts for us to help our clients make sound financial decisions. And it'll really, I think, help you make smart decisions so that you don't outlive your money. Healthcare and housing risk, obviously a big risk right now in the day of COVID here. Long-term care insurance is more critical than ever, particularly those of us that are 50 years of age up to 60, maybe even 65, depending upon your cash flow. You might want to contemplate buying a long-term care policy. Long-term care can deplete your savings rather rapidly and leave you and your family financially depleted and vulnerable. Paying attention to it up front is really important. This is a very complex area. It's something that we have particular experience in working in, and we would love to talk to you about should you have any interest in those conversations or just want to see what it's all about. Should you think that you're going to have a change in your housing need, plan in advance. You don't want to wait too long. If you're contemplating going into an assisted living facility, for instance, in retirement, don't wait until you're so old and infirm that you can't pass the physical tests and the cognitive tests to get in there. They do test you for these things. You really want to make sure that you're paying attention to that and be thoughtful in getting into these facilities sooner rather than later. So, this again comes down with the financial modeling. I think it's really important in the forecasting tools to pay attention to all of that. And of course, we couldn't talk about risks in the age of COVID without talking about market risks, right? Market was up pretty dramatically in 2019, had a serious comeuppance in February and March of 2020, one of the shortest bear markets that I've ever seen. It might have in fact been the shortest bear market that has occurred. And we've had a steady march up and to the right since. Kind of mind-boggling to those of us that pay attention to the markets here, that we can have such a disconnect between the economy, how many people are out of work, how many businesses are shuttered forever, and how the stock market has just brushed it off and continued to go up and to the right. Not sure that it's sustainable, and for right now, it's a definite risk of a potential correction. So with stocks at all-time highs, you really want to pay attention to your allocation. Do you need to take the excessive risk of a full equity portfolio or a significant equity portfolio in light of your needs and goals? If you have significant wealth and assets, I would submit to you that you should be in the preserve and protect mode. Many of my clients are. It's really important to make sure that your objectives and goals are being mirrored in your portfolio. You don't want to be taking 100% equity risk if you don't need it and you don't want it. Just don't fall asleep at the switch. Really want to pay attention to things that we've been seeing. People have been coming to us, new prospects and clients with concentrated stock positions, highly appreciated assets. Obviously, that makes a lot of sense in light of where we've been. We got to be really thoughtful about how we transition those assets over without generating a significant tax hit, particularly in light of where we potentially may be going in 2021, as discussed earlier. We're seeing a lot of aggressive allocations given the age and risk tolerance of clients. And we are seeing clients and investors that have never experienced bear markets. And that's dangerous because, markets don't only go up, despite what some people say. So I'm going to leave you with that. I'm 4 minutes over. It's my pleasure and honor to talk to you. Thank you all for taking the time today. I see plenty of you out there. I'm going to hold off on any particular questions right now just to be cognizant of the time. Should you have any, my contact information is right here. Chris@12pointswealth.com. My phone number, 978-318-9500. Please reach out with any questions. I'd love to talk to you and help you think these things through. Thank you for your time, energy, and attention today. Be well, everybody.